Okay, so you only want to take short positions in stocks or ETFs when the major price trend is down. Here's an example of this is the S&P 500, and right here the S&P 500 is on a buy signal because this is the 1-month price and it's above the 20-month price. So when it's on a buy signal, you don't want to take any short positions in here. Here it's on a sell signal, so it's okay. Here we went long here, and here it's on a buy signal, and you don't want to take any short positions in this market when it's on a buy signal. And I'll show you why in a second here. And then again here we got a sell signal. This is the 2003 through 2007 time frame here. So you don't want to take short positions in here because it's on a buy. The major trend's on a buy. Here we went short, and it's okay to take short signals here. So if you use the 1-month and the 20-month EMA as a filter, it only allows trades in the direction of the major trend. And this helps prevent whipsaw trades when a counter-trend rally occurs. So if you can prevent these whipsaw trades, it can increase your profits, reduce losses, and increase your percentage of winning trades. Now here's, this again is the S&P, and during this 2003 through December of 2007, the major trend system was on a buy. There were 5 sell signals generated by the 50-day and 100-day. So if you didn't use this as a trend and you took those 5 short trades, they all wound up to be losers. So you can see why you don't want to trade against this trend. So I use this as a filter, and I won't take short positions against the trend, the major trend, because it can wind up being a loss, and you'll get whipped around a lot. So this is a good filter for all short trades. And this is the emerging markets index, and you can see here's the 1-month price. You can see it's above the 20-month EMA right here. You can see it was on a buy signal during this time frame, and the 50-day and 100-day had 3 sell signals during this period that were that turned out to be losing trades. So again, you don't want to trade against the major trend. Now I also look at the unbalanced volume, and again, it can confirm the price downtrend. And this is the FXE, I believe. Yes, the FXE. The euro, and again, it's, we have a sell signal here from the 50-day and 100-day. So it's in a price downtrend, but then we want to confirm it with the unbalanced volume, and you can see that's trending down too. So that gives you an indication that the downtrend can be sustained. We looked at this previously, and this is the major trend system, and we saw where $10,000 went to $608,000, and the only reason it had such good profit results is because this includes short trades. So the short trades can be a big part of your profits. And if I did the historical testing just for the long trades only, this number would be much lower. So the reason the historical results on the major trend are so good is because it takes short trades also. An example of where it increases your profit potential.
Chuck, is that only stocks or stocks and options?
This is only stocks. Question is, are these results based on stocks or options? These are just stocks.
You wouldn't actually be shorting those stocks, so this is just an academic exercise, right?
No. If these results are based on taking short trades. In other words, when the major trend issued a sell signal, you went short.
But I thought you didn't short a stock.
Right. You don't want to short a stock. So yeah, these are just the historical results based on shorting the stock.
Yeah.
But you wouldn't want to actually short the stock. You'd want to use the 4 strategies that
right.
Are limited risk. These are individual results, again, and a big part of these results for the major trend system are the short trades. So the short positions can give your portfolio an added dimension. The short positions profit when the stock or the index is declining in price. Most trading programs only trade from the long side because of the high risk associated with short positions, but we saw 4 ways that you can initiate these short positions with limited risk. So that adds a whole new dimension to your profit opportunities. This is just a snapshot of my portfolio on September 15th, 2008. I don't know if you remember that day. That's when the whole financial system was imploding. And around the time of the Lehman Brothers collapse. And that particular day, the Dow was down 504 points, but I took a snap. I trade 10 different accounts, but I took a snapshot of one of my accounts, and here's the closed trades for that day, and then I had open trade profit. So I had a 14% return that day when the Dow dropped 504 points. So that's an example of how the short trades allow you to increase your profit opportunities. Instead of losing money by just taking long trades, I actually made money that day. So,
what time frames do you tend to trade in on the short side?
Question is, what time frames do you normally trade in the short side? And to answer your question, I would say shorter than long trades, but it's going to vary. But usually the down markets are shorter, and the price movement is much quicker on a down market than it is in a bull market. So when I was taking these trades, I didn't know how long it was going to last, so I just hung on to them until.
If you were to put on a spread, you maybe limit it to 3 months or something, or would you?
Yeah, the question is, if you were going to do a spread, for a short trade, yeah, I would do shorter term. I would do 3, 4, 5 months maybe, because the down markets tend to be shorter in duration than bull markets. But that's a good question. I will normally do a shorter term option for short trades.